Hello, welcome back again, guys. Many earnings reports today. In this video, we're examining McDonald's, which had its earnings before a report a few hours ago, and it was actually up about 2% at some point. Right now, it's about neutralized. It's like 0%, 0.1 minus, really. So we're gonna see what's gonna be happening when the markets open up tomorrow, but for now we're gonna examine what the company did in its earnings, and we're gonna see whether it makes any sense to be buying the company right now. If you are new here, please remember to leave a like. That really helps with the growth of the channel, and thank you for that. And also let me know what you think about the current earnings reports, McDonald's and the other ones. Leave a comment below and let's discuss that. And let's see what McDonald's did actually. So net sales dropped 3% here in part by Russia and Ukraine, which actually had to close some of the restaurants there. Global same-store sales, however, rose 9.7% in the quarter. That's strong international growth. That's nice to see. Now, McDonald's said that both price hikes for their items, their menu items and value items that they have added, fueled U.S. same-store sales growth, which was higher than expected during the second quarter. Now, the shares of the company at some point were 2%, as I mentioned earlier. But let's see what they did. Earnings per share $2.55 versus $2.47. So they did better in terms of net income here. Revenue 5.72 versus 5.81. That was actually a little bit worse than expected, but it's not that far, frankly. Now, the company reported second quarter net income of 1.19 billion. But the company also had a 1.2 billion charge related to the sale of its Russian business due to the war in Ukraine. So that actually affected their bottom line here. As you will see, inflation dragged down the company's earnings despite price hikes, and they are estimating, McDonald's that is, that there's going to be like a 12 to 14% inflation for food and packaging in the US. Now that happens a lot during inflationary pressures. You may be looking at the consumer basket pretty much being like 8 to 9% in terms of inflation, but more important items like food, for example, tend to be higher overall in terms of inflationary pressures. And McDonald's is telling us that this is about 12 to 14%, and it does make a lot of sense. And we need to be paying attention to these numbers coming out from these companies here. Now, net sales fell 3% to 5.72 billion here, of course, hurt by Russia and Ukraine. We talked about the global same-store sales here, which seem to have been increased. And as you'll see, an interesting point, same-store sales here struck in China as the government reimposed COVID restrictions, and they keep destroying their economy there in China. But the thing is, growth in Brazil and Japan offsets this weak performance in terms of China here. So that does help them, the sales for McDonald's. And also the internationally operated market segments reported same-store sales growth of 13%. Strong demand in France and Germany. Nice to see, really, from the company. Good stuff. So, things are looking pretty solid here for McDonald's. You wouldn't really expect this kind of report to be following a pretty much beat down in the markets, really. It looks pretty solid, pretty fair here. But what about buying the company? Is it a good buy right now? You will notice that since it's 1 year high, it's about at the same level. It's dropped like 5%, which is absolutely tremendous. The company hasn't really dropped at all, practically speaking, compared to the rest of the market here. And so they're doing fairly well. You can see the 5-year chart. They are almost like not being affected at all by the current economic slump, which is very nice to see from a company like McDonald's here. Very steady company. Now, the PE ratio and price to free cash flow ratio are at about 27 right now. The company seems to be buying some shares back, which is a nice picture, a nice sight to see. But the PE ratio and the price to free cash flow may still be a little bit more elevated than what I would like. Remember, this company doesn't really grow anymore. It's almost like a company that's growing their balance sheet over the years, and they have sustained earnings. They're pretty much having retained earnings that get better and better. It's not about a company that's a growth story here, so it doesn't really make a ton of sense to be paying expensive PE ratios here or price to free cash flow ratios. Now, we're going to examine that in detail with our stock evaluation tool, of course, but it's a first thing to see here that this may be a little bit more expensive than I would like. Now, the total liabilities compared to the free cash flow of the company gives us a story of 8.2 years of last year's free cash flow to pay back all the total liabilities that the company has. It's a little bit elevated, but it may not be too worrisome here. the company has total equity that is negative, and they do that on purpose. I have described that in finer detail in a specific video that I have made in the past. I will link that video at the very end of this video so that you can watch it right after. It's very, very interesting. There's no point in actually reiterating the same things in this video, but if you're interested in the reason why this is negative, it's actually done on purpose, and you can examine the finer details in the video that I'm gonna be linking at the end of this one. Okay, so the net income growth has been increasing, the free cash flow growth has been increasing, but the revenue pretty much has been at the same levels. Now, the company does have pretty high margins here, which is very nice to see from a fast food company here. That's absolutely amazing, frankly. Their return on equity is going to be negative, we examined why, but their dividend yield is sitting at 2% with a free cash flow payout ratio and a payout ratio of about 56 to 57% here. Now, if we take a look at the dividends tab, we can see the finer details about the dividends paid from the company, and you will see that they have been growing over the years and the quarters pretty much. They're paying 2.1% currently, during pretty much today, that is, at the current market price. Now, yeah, they have a little bit of an elevated payout ratio, but it's not too elevated, so they can pretty much probably very easily still sustain their dividend for a while. Now, let's take a little bit of a look at the insider trades here. You will see that we are having quite a few different types of trades here, but nothing too suspicious. After all, actually, there are some purchases as well, like one purchase here back in like 6 months ago, which is generally speaking a very, very good sign. Typically, you don't really see insiders just buying the company. For the most part, they are selling because they are part of their compensation. Now, you always want to be taking a look at what kind of sales are happening here, whether they are like huge lots of sales. Doesn't really seem to be the case. There are some more lucrative sales, but overall, I'm seeing the usual stuff here. Nothing too out of the ordinary, and you always want to be searching for a CFO potentially selling tons of stuff. Now, this can also happen when for example, they have options that they have to exercise in this case. But overall, you will see that while they are selling, they are still keeping quite a lot of their own securities here, so they are selling just a small bunch. The CFO is important, of course, because it's the chief financial officer, and so they know more about the financials of the company, obviously. Now, the senators over here, you will see if we take a look at their sales and purchases. There is just one purchase here from John Rutherford, who purchased a small lot, about 27. Actually, no, that was published in March 16. They did the purchasing in February. Okay, interesting, but let's take a look at our financial statements and see what kind of income the company generates and how. So you will see here that 22 billions in revenue to 23 billions in revenue. So the company doesn't really grow the revenues. They're sitting at about the same rate, so no growth here. But in terms of net income, from 5 to 7.5. So they are much more efficient with the way they are generating income. And that's great to see, because the company adjusts to the fact that they are not really making extra revenue, but still they are making extra net income. So they are doing better in terms of handling their operating expenses and basically making more money. So that's nice to see. Now, the balance sheet of the company here, you will see that the total liabilities, what we examined earlier, is sitting at $58 billion. And total equity is in the negative. Again, I'm going to be linking to a video at the end of this video so that you can examine the finer details of why this is happening if you're interested. But know that this is happening it's not an accident, it's actually happening on purpose. So McDonald's is actually doing that on purpose. So, as you'll see here, 9.1 billion operating cash flow, and minus 2.1 in terms of investing activities because of capital expenditures for the most part, and some other investing activities here, purchases of investments. 3.9 is what they're paying in dividends. That's almost 4 billion. And if you take a look at the free cash flow, they're making 7. So it's actually more than 50%, is what we examined a little bit earlier. It's a little bit too much, but still it's sustainable for the company for sure, at least based on what they did last year. In terms of free cash flow, they're having about 5 billion as well, actually 3.4 in terms of their cash at the end of this period. Okay, let's take a little bit of a look now at the stock evaluation tool and see what kind of price to pay for this company. Is interesting. Now, the company hasn't been growing their revenue, is the thing. It's only basically their last year that they did too well with increasing their revenue. So they did increase their revenue quite a lot, but in regards to the 5-year average, this is actually minus 0.5% here. So that's interesting, and we cannot really go with this level here, 20%. Even though they could keep growing their revenues, we can't go that far with our estimates. Thus, we're going to be much more conservative here. We're going to actually use 0 to see what's going to be happening in the case that McDonald's doesn't grow the revenues at all in the next 5 years, which I frankly don't think it's going to happen. But then I'm going to be using 3 and 6 here and see what the kind of projections we're getting for this kind of low revenue growth from the company. Now, the net income margin, again, it's been increasing for the company. As you'll see here, they have been increasing their margins, which is awesome to see. Now, I'm going to go in between. Again, I'm going to go something like maybe 24, 27, and 30 here. See what we're getting out of this one. We could even go a little bit higher in some situations. The free cash flow margin, again, approaching 100% territory, but a little bit less. 80, 90, and 100 is what I'm going to be trying. An annual return of 13% makes a ton of sense here for this company. And we hit calculate. What are we getting? Let's just see. So yeah, as expected, the company is valued more currently in the markets than what I would like it to be. And even if for our high estimates with a revenue growth of 6%, a net income margin of 30%, we are still sitting at 161 for our high estimates. The current price is sitting at 257, so it's very far from what I would like it to be. And even though this is a fairly solid company that's been doing well, I just can't see myself buying it right now because it's overpriced for what it is. And they could easily be doing 0 or 3% for the next 5 years in terms of revenue growth. That wouldn't be out of the question. They could go back to no growth at all. And so in this case, I would be buying this company for much higher valuation than what I would like if I were to buy it today. So this cannot really be a buy for me right now, even though I like McDonald's. And I would love to have the company, but at a much lower valuation, frankly. But thanks for watching the video. Thank you for watching this through. And if you enjoyed this one, I am linking at the end of this one now to the video that I made some time ago, and I'm explaining why McDonald's pretty much balance sheet is showing equity that is in the negative, and what is happening there, why we're looking at total assets of the company that is in the negative. So take a look at this one, and I think it's very beneficial to watch for somebody who is interested in the finer details about the financials of McDonald's and companies that are doing similar things. Thanks for watching again, and I'll see you soon. Bye guys. Bye bye.